Coming up on Market to Market. Wildfires scorch the West as scattered showers in the Corn Belt dampen prices. Citrus growers cope with a growth-threatening disease and shrinking market share. And in the fight against global hunger, U.S. policymakers opt to buy more food locally. Those stories and market analysis with Darren Newsom next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, August 29 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Government reports this week revealed that the American economy grew faster last spring than originally estimated. According to the Commerce Department, U.S. gross domestic product increased at an annual rate of 4.2% in the second quarter of 2014, up 0.2 of a point from its previous estimate in July. Earlier in the week, the government announced that orders for durable goods rose a whopping 22% last month. Demand for civilian aircraft helped lift orders for transportation equipment by a record 74%, while business orders for long-lasting manufactured goods also increased by the largest amount on record. And in the wake of back-to-back declines, construction of new U.S. homes rebounded in July, rising to an 8-month high. One place where home construction may be on the rise as the months ahead is the Tinderbox, formerly known as California. One of the driest periods in California history has not resulted in the high number of wildfires that experts had feared. Nevertheless, parts of the Golden State are burning. In the Gold Rush era boomtown of Weaverville, crews are building containment lines around a blaze that's chased people from about 200 homes. The area under siege is more than 1 square mile. The zone is full of timber, brush, and other undergrowth. But by late this week, the fire was almost 90% contained. So far this year, the National Interagency Fire Center reports more than 38,000 fires have charred 2.7 million acres in the West. That's the second lowest level in more than a decade. At this time in 2012, more than 7 million acres had burned, the most in nearly 6 years. Another battle was resolved this week that will allow loggers to remove dead wood from the land damaged in last year's massive rim fire. The U.S. Forest Service approved logging in a 52 square mile area blackened by the 2013 blaze. Environmentalists argued logging would eliminate potential habitat for dwindling species in the forest and called the plan a travesty for trees. The removal of timber will be followed by replanting and restoring the forest. Some trees still standing were damaged by the fire and create safety hazards. The debate happens against the backdrop of severe drought, which is crippling many industries in the state. Nearly all of California is locked in the exceptional drought category, according to the Drought Monitor from University of Nebraska. Arid conditions subside east of the Rockies, and the majority of the Corn Belt is enjoying normal conditions. Midwestern crops reflect the virtually ideal weather. USDA estimates 73% of the corn is in good to excellent condition, while the nation's soybeans are also in top shape. Florida's citrus industry is among American agriculture's greatest success story. Despite hurricanes, freezes, and widespread development, the orange has played a vital role in the Sunshine State economy for centuries. But experts say a new threat is putting the entire citrus industry in jeopardy, all because of a mottled brown bug no bigger than a pencil eraser. Asian insects have Florida's citrus growers reaping the wrong kind of green. Citrus greening disease is ravaging orange groves throughout the Sunshine State. The bacteria results in small, bitter fruit and poses a threat to the entire tree.
It will have a ripple effect throughout the Florida economy if we can't get our arms around this disease.
Florida produces 80% of the nation's orange juice supply. Experts are concerned that if a solution isn't found, the $9 billion citrus economy would collapse, taking 75,000 jobs with it. But it's not just greening that is putting the squeeze on the Florida citrus industry. Brazilian growers are strong foreign competitors as the #1 juice orange grower in the world. And health-conscious consumers in the U.S. are cutting back their consumption of what was once a breakfast staple. Last month, domestic orange juice retail sales fell to their lowest level in 12 years for a second consecutive 4-week period. But the most pressing issue besieging the industry these days is greening. Research is underway to eradicate the bacteria-carrying insect Asian citrus psyllid. Some scientists are focusing on grafting rootstocks that have a natural resistance into established trees.
And they seem to be growing and healthy, even though they started out as a diseased plant.
Researchers are trying to make the psyllid incapable of transmitting the disease. But, they caution, that will take time.
The rate research is going, I think that we'll have a lot of really viable solutions within 5 years.
But those may be years growers can ill afford to lose. Since greening was discovered a decade ago, it now covers the entire state of Florida and also threatens Texas and California groves. The United States is, by far, the world's largest donor of international food aid. Last year, America contributed about 1/3 of the $4.4 billion given to the predominant international distributor, the World Food Program. The federal government buys the vast majority of its goods from U.S. producers, but policymakers have begun to purchase more food from foreign suppliers. And while the shift in policy has proven to be controversial in some circles, proponents say it results in more efficient delivery and a better return on investment for taxpayers. Paul Yeager explains.
The United States government began a subtle but significant shift in recent years, moving away from its long-standing policy of buying grain and other food for international donation solely from U.S. sources. Until 4 years ago, nearly every taxpayer dollar spent on buying and shipping international food donations went to U.S.-based suppliers and indirectly U.S. farmers. An analysis by Market to Market reveals, however, that beginning in 2010, the government began increasing the amount of food it purchases from foreign suppliers. In 2013, a record 25% of the money used for food donations was spent outside the U.S. The shift, a deliberate one allowed by budget and administrative rule changes, is designed to help support farmers living in or near struggling or poverty-stricken nations. It is also intended to reduce government costs associated with shipping food overseas.
Well, if there's a drought in southern Mali, which is a country in West Africa, and the northern Mali has plenty of grain, we can actually then have the ability to buy grain in the northern Mali to ship it to the south. And that is, research shows that is actually quite a bit faster than even from preposition.
Preposition refers to the stockpiles the United States has placed strategically around the world so food can be shipped more quickly to nations facing natural disasters or other emergencies.
We issue a tender for these, people bid on it, the best price wins, and then it is literally shipped down, usually through the Mississippi, and then out through Louisiana to wherever it's going around the world, to where it is needed, and literally on a boat, and then it is offloaded on a boat, and then loaded onto trucks usually, and then driven from a port to the actual place where the beneficiaries need the food.
The shift has happened as Americans weigh the hoped-for cost savings and possibility of helping struggling farmers elsewhere with the abandonment of a tradition of buying only U.S.-provided foods and shipping at least half with U.S.-owned cargo ships. Few other, if any, of the world's so-called donor countries require donated food be purchased from its own growers and suppliers. Most nations give money rather than food. Canada decided 6 years ago to relax its food aid rules and now donates cash to the World Food Program and the Canadian Food Grains Bank rather than food.
One of the objections to the efforts to increase the amount of money that could be used locally to grow crops was from both U.S. farmers and shippers. Both claimed that it would cost Americans jobs if more money was used to grow crops locally rather than having U.S. crops sent overseas. The amount of money being spent for this program is very small compared to overall exports of U.S. commodities. Therefore, it's really not costing the shippers or the farmers a lot of money to increase the amount of crops that are being grown overseas.
The United States began the tradition of providing taxpayer-funded international food aid in the aftermath of World War II.
And in the process of rebuilding Europe, we found that not only was it good for the Europeans, but it was immensely good for Americans and American business too, because as the Europeans were rebuilding their economy, they needed American products and American services, which provided in great amounts by the United States to those countries.
In the ensuing 60 years, even when drought or other issues pushed prices higher, the government has purchased enough food domestically to donate.
There are a lot of strong feelings about providing economic and military assistance to other countries, but foreign aid is about 1% of the entire federal budget. Foreign aid is a lot less money than most taxpayers think it might be in terms of how much gets spent.
The United States Agency for International Development, or USAID, coordinates the majority of the government's international food aid. Recently, it has placed greater emphasis on supporting programs that help other nations feed themselves.
We have a large program called the Feed the Future Initiative. Part of its goal is to increase the productivity of the existing farms, but also to bring in marginal lands back into production. And Food for Peace also addresses those issues by doing those same things.
The push toward local and regional procurement means that food is purchased, if possible, within the country or region where the food is needed. A priority is placed on buying from underdeveloped nations, with the exception of enemy states. But local and regional procurement is not without challenges. Government leaders worry about the impact on foreign markets when buying a large amount in the region. American Farm Bureau Federation President Bob Stallman has written about these changes, arguing that a cash donation system creates more opportunities for the money to be used on something other than food. One taxpayer advocate, however, praises the greater flexibility provided by the move to local procurement and the potential for reducing shipping costs.
This helps increase the amount of crops that are available. It reduces costs for the taxpayers, and it's one of the few positive aspects of improving the effectiveness of foreign aid.
I've never been to a place where food aid was not appreciated. All the countries I've been to, the quality is good, the people love the food, they eat the food, it saves their lives. And in addition, it also, of course, has a whole public diplomacy concept to it, too, for the developing countries, people to see that the Americans care about them. Because as you can imagine, we don't always have the best appearance overseas. And by not providing food aid to that, we would literally be relegating huge amounts of folks to poverty and sickness and malnutrition for generations.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
The market moved mostly lower in the commodities this week over fears of the ongoing tension between Russia and Ukraine. For the week, September wheat inched slightly lower, while the nearby corn contract followed suit with a 7-cent loss. The news wasn't good for the soybean market either, as the September contract fell by 77 cents. Nearby meal prices were a rare bright spot, inching out a gain of $6 per ton. In the softs, cotton rallied this week as the December contract rose 39 cents per hundredweight. In the dairy market, September Class 3 milk increased 40 cents, and the deferred contract followed suit. Over in livestock, the bulls were back as the October cattle contract rose $4.42. Nearby feeders moved $7.75 higher, and the October lean hog contract rallied more than $5. In the financials, the euro lost 11 basis points against the dollar. Crude oil reversed course with a gain of $2.27 per barrel. COMEX gold increased $7 per ounce, and the Goldman Sachs Commodity Index added more than 8 points to settle at 611. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darren Newsom. Darren, welcome back.
Thanks, Mike.
We led the market segment off there with a touch on the tensions between Russia and Ukraine. Is it an invasion? Is it not an invasion? He said, she said. Where is this going to point the wheat market as we roll into this fall?
You know, the biggest thing is here we are coming up on a 3-day holiday weekend, and you could tell the markets were nervous. If we see, and it's perfectly logical to think that we're going to see an escalation of this over the weekend because markets are closed, most of the world's not going to be watching, I would say that's going to continue to bring some buyers back into the wheat market. I think there is this idea that if we see this tension continue to grow and go on and on and on, that eventually it is going to bring more export business to the United States. Right now, really hasn't happened. Every time we see some of these tenders being filled, a lot of times it's still coming from Russia, it's coming from Ukraine, it's coming from other places besides the U.S. But at some point, the thought is, U.S. wheat's low enough, still high quality. Europe's had problems with the quality of theirs due to weather, their crop due to weather. At some point, it should bring some more business back to the U.S. shores.
So now advice to producers out there sitting on particularly the higher quality wheat, when do you pull the trigger on marketing? You
know, with the way the charts look right now on the December, both Chicago and Kansas City, and even the Minneapolis, so your winter wheat and your spring wheat, the charts are looking more bullish right now. So I would sit back. You know, we had some locked in before harvest. Now we're probably sitting on, you know, at least maybe 40 to 50% of 14 production. I think you can sit back, let this market go. It looks like it wants to go up. The problem it's going to have is the U.S. dollar index is also gaining momentum. The higher the dollar goes, the more difficult it is for us to really increase, the U.S. to really increase its export program. So wheat really fights against that. But just from a pure supply and demand, from a technical point of view, it looks like the market may want to move up for a while.
Looking at it from the perspective of the strengthening dollar, is there enough demand in the U.S. to continue to support prices where they are today? Should exports fall off?
You know, I would say so. And I don't really expect exports to fall off. I mean, we have such a dismal projection for U.S. exports in 14-15 anyway. I think it's something like 925 million bushels or something along that line. Really shouldn't take much to fulfill that. So we should be able to start up on a pace where it looks like we're going to do that and maybe even do a little bit better, even if the U.S. dollar index is going higher.
Okay. Well, let's jump over into the corn pits. Today is the last day of old crop officially, but there's still a lot of folks out there with old crop in the bin. As we're sitting here heading into Labor Day weekend, how do you market that effectively knowing you've got a big crop coming?
It's tough. It was one of the key points of discussion with attendees at the Farm Progress Show this week, and you know, it was one of the questions that they really want to know. You know, what do we do with old crop bushels? And to me, it reminds me of the 2005 scenario where Katrina shut down the river system and everyone was stuck holding their bushels in front of a big harvest. They just couldn't move it, and so we saw the similar situation where basis started to weaken, and I'm afraid we could see that as well. So in the old crop corn market, I think we're going to have to pick our opportunities. If we have some local basis, again, the difference between 2014 and 2005 is all the ethanol plants now that are bidding for corn. So you may see some localized basis hold in better than what we may see at terminal or river basis. So if you can find the opportunities, and if we get, say, a small rally in the market, pull the trigger, start getting out of the corn that you need to get out of in order to make room for what's expected to be a record 2014 crop.
Okay. Now let's jump into that potentially record 2014 crop. As we sit here today, where do you see corn headed in the short term?
In the short term, corn seems to be comfortable going sideways. It's got a little bit of a range in the December corn contract between 358 and 381. 28 cents range or something like that, 23 cents, whatever it might be. So it looks like it wants to sit here for a while. Now, what possible reason would corn have to rally? That's the question that everybody's asking. You can't make a fundamental argument for a higher corn price. Not looking at a 14 billion bushel crop, not looking at average yield possibly of 70 bushels per acre or better. But yet the market's still showing it might want to go up. So is it saying that, number one, it doesn't believe the production is going to be there, or number two, demand might actually be stronger than what's being projected right now? We're expected to see a little bit of a year-to-year loss in total demand from 2013-14 to 14-15. So, you know, there's something out in the market right now that we don't know what it is that has stabilized the corn. Market's taking a wait-and-see approach right now. And, you know, if the weather turns out fine and production turns out to be as big or bigger than expected, yeah, we're going to go down. Market's going to go down. But for right now, market just seems, the new crop corn market's just taking a wait-and-see approach.
Well, and that leads kind of right into our Twitter question. Richard from Belle Eagle, Tennessee is curious, if you were an odds maker, what are the odds of a breakout above 381 or below 353?
Right now, I'd say the better odds are probably to the lower side. If we look at the D-Smart spread, we've got around a 13-cent carry, so the fundamentals are still bearish this market. We're sitting here staring at another USDA report coming along at September 11th, so more than likely that'll be a bearish number. Weekly crop progress or condition reports probably will continue to be bearish. So it seems like the most logical direction for the market to do now is to take out the 358 or whatever it is low, move down another 20, 25 cents right around the time of the report, possibly in reaction to the USDA report. And then what interests me most is what happens after the report through the end of September, because at that point we could actually see some bullish technical signals established on the long-term monthly chart. And if that's the case, the market's indicating it's changing its mind. We may not know why, but it's certainly indicating a change is possible.
Okay. All right. Well, and then so as we jump into the soybean markets, the big number being thrown around as we watch that old crop catch up, or excuse me, catch down rather, with where the new crop's at today. Apparently, we're rolling out of the old crop scenario.
We are. Now, the thing about soybeans, it's different from corn, is that we are so tight on old crop supplies that these rains that continue to move through the Midwest, if it starts to, you know, create the idea that harvest is going to be pushed back, that's going to continue to strengthen basis based on the old crop tightness, the old crop tight situation. So we've still got like a $1.50, $1.60 national average over national average basis over the November contract. And so that's going to carry forward into the new crop, at least for a while, possibly support the market a little deeper into September than it normally does, until the combines actually start to roll and we see what's actually out there in the soybeans. Now, once we start to get harvest going, you know, again, very similar to corn, we've got this record production supposed to be coming. That could be enough to push the November futures down below $10, possibly to $9.90, maybe to $9.30. After that, I think, again, global demand's going to step in, start to stabilize the market, and we could start to turn the corner back higher.
Okay. Well, now let's jump over to the livestock markets as we talk about markets turning back higher this week. In fat cattle, we saw $4 and some cents rise. What changed? Was it a fundamental change or technical?
To me, it's mostly technical. We saw the October live cattle contract come down, retrace about 50% of its previous move. And when you have a strong fundamental market like we've had in corn, 33 to 50% retracement is about what you would expect. So we had that, now it's bouncing back. The problem is we aren't seeing the cash market come back as quickly. So if the futures markets start to pull away from the cash market, basis starts to weaken, it's usually a warning sign that we're probably not going to go all the way back up and test those highs. So I would look for some resistance, say short term in the October contract, you know, in that low to mid 150 range. And I think, you know, if we need to get some short-term sales on, maybe cover for the next couple of months, might not be a bad opportunity. Looks like it wants to do it. If the cash market really starts to look stronger, maybe it pushes a little bit higher, but I think we're going to have some opportunities to get some sales on.
And would you be looking to sell options as opposed to outright futures? Would it?
I would be comfortable in the futures market because, again, really your risk is going up and through the previous high. If we didn't sell the previous high, and I can certainly understand why a lot didn't get it sold there, but we get this retracement, we get this pullback, you know, this is a little bit of a rally. Don't see it coming in the cash. Yeah, I wouldn't have any trouble selling the futures.
Well, let's jump over into the feeder cattle market. Again, big rally, $7.75 run. Same story as the fat cattle?
Very similar. You know, it's got support coming from the live cattle market on the idea that we're still going to have great demand for the feeder cattle. and you've got corn market that just isn't going anywhere. And as we talked about with that previous question, the best odds are that it's going to go down, at least short term. So similar situation here in the fall months. You get a little bit of a rally, gaining back some of what's been lost over the last few weeks. You probably look to go ahead and sell it. Maybe sit back a little bit on the deferred contracts, the winter contracts, maybe even the spring contracts to a certain degree, till we see what really starts to develop. Maybe we start to see that turn in corn at the end of September. Then we make a move in the feeder cattle market.
Okay. Now, jumping over to the other white meat, on the lean hog side, we saw the first sizable weekly move upwards in the hog market here in quite some time. What changed here?
Well, you know, the sell-off that we've seen wasn't overly surprising. I was kind of targeting, say, this summer time frame, but then the sell-off to last into the, you know, maybe late September, early October. But it fell so quickly that it found buying immediately, and not only did it find you know, just some short covering buying, it found some renewed commercial buying. And so it looks like the cash market may start to firm in the hog market, a little bit different picture than what we're seeing in the cattle. And this is what you want to see. So is it going to go skyrocketing right back up? It's hogs. Anything's possible. But, you know, it may be a little bit more difficult to get it to rally back up to its previous highs. But a test of where we were this summer, you know, say deeper into the fall, maybe early winter, isn't out of the question.
On the demand side, have we seen any fundamental shifts in consumer preference moving beef to pork? Is that any issue in this market at all today?
You know, reading DTN's livestock analyst, John Harrington, it certainly seems like there is this pattern that we might be starting to see some of that. We do know that domestic demand for cattle has been a little bit soft here recently, which is kind of a bad sign with you know, this being Labor Day, you know, the peak of grilling season. And some of it has been moving over into other meats, some of it going over into pork.
Okay. Well, Darren, I want to take the time to thank you for being with us here this week.
Well, I appreciate you having me on, Mike.
That wraps up this edition of Market to Market. But we will continue our discussion and answer some of your questions in our Market Plus segment online. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed, Facebook page, and the rest of our social media outlets exclusively at the Market to Market website. And be sure to join us next week when we'll revisit a trio of Kansas brothers whose internet video clips promoting agriculture have been viewed by millions. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.